Good evening, everyone. Welcome to our Mississippi State Alumni Homebuyer Workshop. My name is Jason Maida. It's great to be with all of you this evening. Thank you so much for taking time out of your busy schedules to join us. I know we're just about a minute or so past the top of the hour, so we'll allow everybody to get kind of settled in for tonight's class. This is a very interactive session that we teach. It does have a runtime of about an hour. Now, we will record tonight's class. We will also have it up on our YouTube channel and share back all of our presentation material with our audience. So those of you that, because you're obviously here, you signed up for the class, all the sign up or attendees will also receive all of this presentation material. So we teach 4 of these classes a year for our partnership with Mississippi State. Excited that you can join our second installment of those 4 classes for 2025. A lot of exciting things going on in the housing market. And so I think now's a really great time to have a discussion like this to learn a little bit more about what home buying can be for you. Just a little bit about our organization. So I work for a company called APM, or American Pacific Mortgage. We are a nationwide lender. We're the 9th largest lender in the country. And I've had the pleasure of being one of the top producers within the organization, been in the lending industry for over 20 years. And I teach classes like this throughout the country to help support and educate our local communities in homeownership. So a lot of our discussions center around first-time home buying and just preparedness for taking on home ownership. And I've got a chance to discuss many options with some of your fellow alum within Mississippi State and all across the country, just to kind of help them understand more about their options. After tonight's class, we'll talk a little bit about next steps in your journey towards home ownership if you want to get connected with us for a consultation. But we first want to kind of help educate you on what home buying could be for you. Here's some of our talking points for this evening. We'll talk a little bit about the housing market, what's going on with it, both from like what's going on in housing, but also what's happening with interest rates. And is there maybe a light at the end of the tunnel when it comes to where interest rates are going? We'll also go through a budgeting exercise to kind of better understand what does it look like to continue renting versus what could it look like if I decide to purchase at some point in time. And then we'll kind of spend some time looking at credit, having our credit in the best possible position as I prepare for home ownership, and then look at different loan programs that are available to me as a first-time home buyer, whether that's FHA loans, conventional loans, even some of our VA home loan products. We're going to spend some time looking at some of the various characteristics of loan programs. And then we'll transition to savings for home ownership. How do I get myself in a position to have enough savings for down payment as well as closing costs? And then we can also explore various first-time buyer programs that are available all across the country. I also want to take you through the steps of home buying. So we call that our 6 steps of home buying. What does it look like to transition from attending a class like this to being pre-approved to purchase a home to eventually getting the keys to my home? So I'll kind of walk you through what those milestones look like, and again, kind of what our consultative process can be. All right. Now, I know we have other classmates kind of filing into our Zoom session, so we'll let everybody get settled in. This, again, is a very interactive session. So if you do have questions, feel free to use the chat function within Zoom or Q&A. I'll have kind of be monitoring both windows up on my screen here, and I'll grab some of those questions as we roll through tonight's session. At the very end of tonight's class, we'll kind of circle up and just answer any follow questions that you have. And again, all the presentation material will be sent back out to you tomorrow, as well as the recording of tonight's class. All right, well, let's talk a little bit about buying. Now, buying is probably going to be one of the biggest financial decisions you decide to make. So obviously, you're spending some time on a Wednesday night to learn a little bit more about home ownership, so you clearly understand the magnitude of buying or making this decision. Now, when we think about that in pursuing home ownership, there's a lot of great benefits that come along with home ownership that we might not realize. One is that we can create better stability in our housing budget. So we don't really have to worry about a landlord that's increasing the rent on an annual basis as I decide to maybe renew my lease. This home should appreciate over time. So as we see our home values go up, as we pay down our balances, the difference between what my market value of my home is and what I owe on my balance is called home equity. For most of us across the country, that's probably our number one asset that we have. So it's a big deal. And that does have the opportunity to create generational wealth for most families across the country. And there can be some tax benefits that come along with owning a home that we might not realize. Things like potential tax deductibility deductibility of interest, being able to maybe deduct energy efficient upgrades that I make to my home. So a lot of those things when we consider home ownership can be super appealing for us, right? And what I would say is that when we budget ourselves for home ownership, it's not necessarily an apples to apples comparison because we have to factor in all of those great characteristics that become a part of ownership that maybe we don't get to participate in as renters. Okay, so now as we think more about our housing budget for home ownership, I wanted to walk our group through a rent versus buying calculator so we can kind of frame up for us what are the monthly costs going to look like. But once we add back in things like appreciation of our home, tax benefits, could home ownership look a little bit more appealing for me? So let's take a look at this rent versus buying calculator. And I'm going to kind of walk or move us into our browser here so we can kind of do a real-time look at what this calculator could be for us. And again, you'll have this to be able to kind of run your own customized exercise on, but I've kind of pre-filled this calculator out for our group tonight just to keep us on track with our timing. But let's kind of dive in a little bit deeper. Let's say, for example, we have someone that's paying $1,500 a month in rent. You can see here, and then they had rental insurance expense at $15 a month. And then we have a projection that their rent will increase 3% on an annualized basis. Okay, so that's kind of in our rental column, if you will. Now let's look at the homeownership side of things. So if we drop into the home purchase tab, we have a purchase price of $275,000, minimum down payment of 3% for a conventional loan. We'll talk more about program guidelines in just a bit as part of our discussion in class. We have property taxes for my home. We have the insurance expenses that I might have in insuring my home. And then I have maintenance costs for my house, right? So that all gets kind of plugged into my homeowner scenario. And then we also have to think about financing for that home, and that's a big part of what we're going to dive into in tonight's class. But we assume a 30-year fixed mortgage when it comes to the home financing. We have an average interest rate, which kind of fluctuates right now between 6.75 to maybe 7%, give or take the day. And then we have origination costs for our loan. So that's what a lender is going to charge you for your financing costs. Now, one of your benefits that comes along with not only getting the access to our classes with Mississippi State alum is you also get discounted interest rates or processing fees in conjunction with your financing. So we get a chance to discount your closing costs $750 as part of our partnership with Mississippi State. And then discount points are really an optional thing for a consumer. That's where you can decide to put additional funds out of pocket to bring down your interest rate. Usually one discount point is the equivalent of 1% of my loan amount. And generally speaking, that 1% out of pocket expense will bring down my interest rate about 0.25%. Now, there's also other settlement service costs that are involved with the home purchase, things like title and escrow fees, attorney fees, some of the local county assessment fees. Those are all going to be part of what we call as closing costs. Now, closing costs, we generally recommend clients to budget about 2 to 3% of their purchase price for closing costs. Last tab we want to look at is some of the other assumptions we should consider when we're thinking about home ownership. One would be, what's the appreciation rate look like in my home? How fast is my home going to go up in value? How long I'm going to be in my home? What is the selling cost going to look like? So if I project myself to be in this home for the next 7 years, how much is it going to cost me to sell my home at the end of 7 years? And then I need to factor in local, state, and federal taxes, as well as what the comparable savings rate might be when I think about maybe just holding on to my money, right? So when we look at this calculator and we compare, first of all, our budget, right? So one of the things we're going to have to really understand is that how far can I go up in monthly expenses? So if I'm at $1,500 a month in rent right now, well, in our scenario here for homeownership, my monthly payment will go up to about $2,300 a month. So that's an $800 increase on a monthly basis. Assuming I can afford that, when I look at my total cost opportunity over those next 7 years, if I was to own a home versus continuing to rent at $1,500 a month, I have about a $38,000 opportunity of owning my home versus renting. And for many of us, that's a big, big number, right? So when we think about jumping up from $1,500 to $2,300 a month, we also have to factor in all the great benefits that come along with home ownership, appreciation of my home, tax benefits. Those are all things that hopefully can be baked into the equation, that can make a lot of sense for us as we consider home ownership. Now, we also have to obviously be financially ready. And, part of attending a class like this is to kind of just do the checklist of making sure that we're in a great position financially. And we'll talk a little bit more about what that looks like for you when it comes to qualifying on the home financing side. Now, I want to talk a little bit about the housing market and what's going on. We're kind of going to spotlight what's going on in Mississippi, and I'll kind of give you a little bit of a nationwide look at things. We today are in the spring buying months. So generally speaking, that's going to be the busier times of the year because it's warmer in most parts of the country. So buyers are more active. Sellers are putting their homes on the market. We generally see more sellers putting their homes on the market just before Memorial Day weekend. But what's interesting in the housing market right now, we are starting to see inventory levels stack up a little bit, meaning homes aren't selling as fast as they once were. Now, that's for possibly a variety of different reasons, maybe just concerns about the local or U.S. economy, interest rate concerns, that kind of stuff can stack up inventory. You can see in the Mississippi housing market right now, we have average days on market about 46 days, which is probably pretty in line with what we're seeing nationwide. But then we look at other states like Georgia, Texas, Colorado, Florida. We are seeing quite a bit of a backlog in inventory in those markets, which can tend to be make it more appealing for buyers, right? So, as you see more supply stay on the market, that gives buyers a better edge when it comes to negotiating. In many markets across the country, you could argue that we are starting to see a buyer's market in front of us. Now, as interest rates change, which we're going to talk a little bit about that in just a minute, that buyer demand will eventually pick up right now. But I think we're in an interesting time in the housing market that there is really a great opportunity for many buyers. 44% of all transactions being done across the country currently today have some type of seller concession being negotiated, which basically means the seller is contributing on 44% of the transactions out there, some type of credit that can go towards the closing cost or funds needed for a buyer. So sellers are trying to make their properties more attractive by providing those concessions to buyers. So, I think that presents a really interesting opportunity for many buyers. Now, interest rates will determine at times for some buyers, if they're going to make a move in today's market. So, generally when we have a higher interest rate market like we have today, it will put some buyers on the sidelines. But if we are financially fit and ready to enter today's market, I think even though we're at elevated levels, there's still some opportunity for buyers to enter this market at better price levels on homes, essentially. Because at the end of the day, many buyers that are buying today at elevated rate levels will have the opportunity to do what we call as refinance later on down the road. So if I bought today, let's say at 6.875%, 3 years from now, rates are now at 5.75%. That'll probably make some sense for us to consider refinancing at that time. And many of our existing clients that are homeowners today will be considering those options in the next few years. Now, let's take a look at what interest rates have done in the last 12 months. And we're going to look at this slide here. The blue line represents the 30-year fixed home mortgage, and you can see just kind of a wild ride that we've been on in rates. Part of that is just kind of what we're seeing, the on again, off again with, uncertainty in the U.S. economy, discussions around tariffs. Are they happening? Are they not happening? What's going on with inflation numbers that are coming in? What's going on with employment numbers? All of those factors are influencing, what interest rates are doing on a day-to-day basis. Now, we did see a report come out earlier today that inflation, the cost of goods, has cooled a little bit year over year. It was actually dropped down to 2.4%, which actually beat expectations. So our hope is if we can continue to see more and more signs that the inflation is starting to come down, it will hopefully prompt the Federal Reserve to bring down interest rates and cut interest rates. When we hear that eventually the Federal Reserve will cut interest rates, that will have a direct impact to what our savings rates are that we receive from our local banks, the cost we pay for personal loans, credit cards, auto financing, but it will also have an indirect effect on mortgage interest rates. So it's a good thing, right? So there's two mandates that the Federal Reserve has to bring down interest rates is to get inflation to 2% but it's also to look at what's going on in the labor markets and to see if we're having some, strain with, job openings or just overall kind of unemployment concerns. So we're obviously watching that really carefully as we're kind of monitoring interest rates. Before we leave the interest rate discussion, just want to kind of give you a quick look at what we've seen in the last 20 years in interest rates. Now, 20 years ago, interest rates were almost identical to what they are today, but home prices are obviously a fraction of what they are today as well, too. But I think as we look at the last 20 years, you can see interest rates will cycle. You can see this is kind of the housing crisis of 2008. But then I think it's important to note here, this gray bar represents the pandemic. And so that's when we saw the lowest interest rate levels just on the end of 2021. Rates hit 2.5%. We're probably not going to go back to 2.5% rates, at least let's hope we don't, because that means probably something catastrophic has happened in the global economy. But an average interest rate ultimately probably settles somewhere in the high 4 to 5% range. We're certainly a long ways away from that today, but we eventually will cycle down to those levels. It's not a question of if, it's more of a type of a when situation. Now, interest rates are not the same for all of us when we decide to take out financing. There's various characteristics that go into that. Things like credit score and eligibility, how much I finance, what type of program I'm going to do, what does my down payment look like? And we also talked a little earlier about, do I pay discount points to bring down my interest rate? That can also influence what I pay in interest. And then the term of my loan, most first-time buyers are going to elect a 30-year fixed mortgage because that's the longest term, generally gives us the lowest payment. But at times we may want to shrink that term down to maybe 20 years or 15, or in some cases 10 years. That can also bring down my interest rate. Ultimately, as we kind of meet with clients to design their home buying options, we're going to figure out what the right setup is for their financing, and what terms looks like, what the right product is, because ultimately we want to make sure that we hit the mark when it comes designing home buying plans for our clients with their goals and objectives of home ownership in mind. All right. Now we want to talk a little bit about credit. And before I do, I just want to just open up to the audience. Any questions so far about some of the content you've heard so far? All right. Any questions out there? Okay. All right. Feel free, if you do have questions, go ahead and use the Q&A or the chat function in Zoom, and I'll definitely get those answered on air. Let's talk a little bit about credit. Now, there are minimum credit scores for each product that is offered by us, the lender. You can see some of those kind of main products listed here below, and the minimum credit score for each one of those products. Now, many of us in today's class have some type of visibility to our credit score, right? So you're using some type of monitoring service, whether that's through Credit Karma, TransUnion, Experian, Equifax, whatever the case may be. And that's awesome. But it's important to understand there are 3 different models to credit scoring. There's the credit card model. So if I go to apply for a credit card, that's the applicable model. There's also auto financing, and then finally the mortgage model. So as you're pursuing home ownership, we're going to use the mortgage model in determining financing. Now there's 3 different credit agencies. There's TransUnion, there's Equifax, and there's Experian. We always take the middle credit score for all borrowers. So what does that mean? Well, let's say I'm at a 760 credit score as my top score, 740 is my middle score, and 720 is my lowest score. Well, to determine qualifying, we're going to use the 740 credit score for eligibility for our client. Now, that'll create some determination on like what product we look at, what our interest rate might be, as well as the cost of mortgage insurance if I'm putting less than 20% down. Now, if I'm going to apply with my partner, but let's say my partner scores are 700, 680, and 660, well, the lowest middle score between my partner and I, my 740 and my partner 680, is that 680 score. So we would use 680 for qualifying purposes. And so those are discussions we're going to have as we meet with our clients to see how we can kind of optimize their home buying plan. But we ultimately look at the lowest middle credit score between both borrowers. Some of the other topics we're going to talk about in our credit segment is around credit utilization, how to manage revolving debt, talk a little bit about account closures. So if I close out a revolving account, what is the impact to my credit score? When we think about credit and how long maybe a negative item is going to be on our credit report or how long it's going to impact my score, it's usually within the first 12 to 24 months from the date of the event that's going to impact my score directly, right? Now, how long is it going to stay on my credit report? This matrix kind of answers that question. So if you, whatever the particular item is, this is how long it's going to stay on your credit report. But like I said, the impact to your score is in the most recent 12 to 24 months from the date of the event. So let's say I had a student loan payment that was late in October of 2024. Well, that's still within the last 12 months. So it's probably high impact my credit score. But as I get further and further away from that event, make on-time payments, and of course, stay on time with the rest of my accounts, then I should start to see my score organically grow. Now, if we look a little closer at the FICO score calculation, this is kind of the weighting of the score model for mortgage. So 15% is going to be how long have I had credit? So the longer my credit file is open, the larger or the higher my credit score is going to be. So if I have a 6-year credit history versus maybe another client that has a 6-month history, that 6-year history is going to usually show better, assuming they have on-time payments and whatnot. So that's 15% of the model. 20% is going to be how much new credit am I trying to access? So am I trying to open up new accounts? Do I have new inquiries that are showing on my credit report? Now, there is 2 different types of inquiries. There's a soft inquiry and then there's a hard inquiry. Now, in our process, we only start with a soft inquiry. And the reason why we do that is because many of our buyers, their timeline of buying really changes. And so we don't want to impact their credit score in providing them options. We want to at least get them a home buying plan set, get them pre-approved, and then start their path towards home ownership, but only do it with a soft score. A hard inquiry can impact your credit score. Now, there are rules in place for both mortgage applications and auto applications that if I do apply with a lender today, which would be day one, I do have 30 days of time to shop around with as many lenders as possible. But from our perspective, we really feel like that soft credit inquiry is useful not to impact our clients' credit scores initially figuring out their home buying plan. 30% is going to be how much credit do I have in use from a revolving credit perspective. So if I have, let's say, $10,000 in total limits on my credit cards, but I have $5,000 in credit balances, that means I'm at 50% utilization of credit. Now, if I've continued to add more onto my balances, and now so let's say my balances are $7,000 on $10,000 of limits, now I've pushed those balances up to 70% utilization. Our rule of thumb, first of all, would be to get those balances pushed down to 50% utilization. That'll help improve my credit score as opposed to the 70% utilization. Then I want to work towards 30%, and then the optimal level is 10% utilization of credit. Now, let me give you a quick tip on how to manage utilization of credit when you take a look at your credit cards. So on those credit account statements, there are 2 important dates. One is your due date, which we're all aware of because that's the date we send our payments in. The second is your billing or statement date or your cycle date. That is the time at which all of the credit activity is now closed out for that time period for the previous 30 days. So any charges I've made, any credits, any returned items, all that stuff gets reflected in that activity history. My tip for our class tonight is that if you can pay down the balance or pay it off ideally before the end of the billing cycle date, then what happens is when the credit card issuer sends out the information to the credit agencies, you do show a much lower balance, which in turn shows a lower utilization and then improves your credit score. Especially as you're preparing to make major purchases like obviously a home, we would really try to manage down that credit balances to try to help improve the credit score. Last thing is payment history. That's essentially how have I paid my bills. Obviously, we want to have that on-time pay history. If you have a late payment, like I made the example earlier, like a late payment in October of last year, if that was a 30-day late, then that's going to have an impact on my score. The late payments are rated as 30-day lates, 60-day lates, and then 90+ day delinquencies. So the more significant or higher the day of delinquencies on that account, the bigger impact I'm going to have on my credit score. Now, it is in the most recent 12 to 24 months, but the bigger the number of days delinquent that we see on the credit report, the bigger impact we're going to have on the score. Now, one of the things that gets identified on credit reports is student loans. And I know a lot of our federal student loan debt, if any of our class does have federal student loan debt, is now starting to come back into repayment over the next 60 days. Now, whether you're in a repayment plan or not, when it comes to financing a home and just understanding your options and what your eligibility looks like, we do have to examine the status of student loans. So whether you're in forbearance right now, just because of your payment arrangements, or you're back in school and you're in deferment, we still have to count a minimum payment when it comes to qualifying. So let's say I'm going to apply for an FHA loan. Well, on an FHA loan, we have to take at minimum 0.5% of the balances to determine the qualifying payment, even if I'm in forbearance or in deferment. So let's say I have $75,000 worth of student loan debt. The minimum payment that I would have to count for the client for qualifying would be $375. Now, if we do a conventional loan, which we're going to talk about product guidelines in just a minute, let's say a Fannie Mae or Freddie Mac loan, I do have to count 1% of those balances as the monthly payment, or $750. So that can change things a little bit from a qualifying perspective. Now, the ideal situation for most clients is if we're in an income-based repayment scenario that has active payments right now, because generally the income base is going to be based upon what you provide in income, so it generally will bring that payment lower. So, if we have a client that has a $250 payment on an income-based amount, we can certainly use that for qualifying as long as they're in active repayment status. Now, the reason why we look at things like student loans is because every product that is offered by us as a lender has different guidelines or stipulations that we have to meet in order to support the clients with whatever financing resources they need. I want to spend some time now talking a little bit from a high level perspective of what some of these various loan programs look like. And many of you in class today have already kind of probably heard some of this terminology, but we're going to dive a little deeper and give you kind of a few takeaways as it relates to different products that are available. So the first product is a conventional loan. That would also be known as Fannie Mae and Freddie Mac. You're hearing the administration talk a little bit about, like, taking Fannie and Freddie and taking them out of conservatorship from the U.S. government and making them more private entities. So there's a lot of debate going on with that right now. But ultimately, within Fannie Mae and Freddie Mac's guidelines, they have a minimum down payment of 3% on the conventional loan, minimum credit score of 620, up to a loan amount of $806,500. That's called the conforming loan limit. That loan limit gets set every year by Fannie Mae and Freddie Mac. Usually right around September, October, we get word of that, and that gets implemented right away, and it kind of migrates into the following year with that particular loan amount. Now, if you're joining us from what we call high cost of living areas, you can go to higher loan amounts, but once you go beyond the loan amount of $806,500, the minimum down payment jumps from 3% to 5%. So let's say, for example, one of our classmates in today's session is buying in Alexandria, Virginia. We can certainly use a conventional product, but if they're buying closer to $900,000, then they are in a high cost of living area, and then we could still get support for that financing even beyond the conforming loan limit of $806,500. Next product is the FHA loan. That FHA product stands for the Federal Housing Administration. It is a government insured loan. Minimum down payment of 3.5% and a minimum score of 580. The maximum loan amount does change based upon where in the country we're going to purchase using that product. So generally, the loan amounts will change based upon the county that I want to buy in. Now, with FHA and USDA, which is just right below these are both government insured products, okay? Now, there was some changes in May to eligibility for those products. So no longer can you be a non-resident here in the United States and get access to those programs. You do have to be a permanent resident to be able to participate in those programs. So that was a pretty big change that came about last month. However, you can still be a non-permanent resident and participate in a Fannie Mae Freddie Mac conventional product. FHA will be an alternative to, say, a conventional loan for some clients because it does have a little bit more flexibility when it comes to qualifying under their guidelines. Next product is a jumbo loan. Not really typical for first-time buyers, but it gives you a little bit more funding resource because it allows clients that need more funding beyond the conforming loan limits or FHA loan limits to get additional financing. But there is a little bit of a trade-off. There's higher credit score requirements and a higher down payment requirement. The VA home loan is for our veterans that have eligibility under that product. VA Home Loan's a product that provides the veteran with 100% financing, so it's a zero down payment option. And there's a minimum credit score of 620, but the VA product has a lot more flexibility to support the veteran in home ownership. There really is no maximum loan amount. And for veterans that has any type of partial disability, there's a thing called a VA funding fee that they become exempt from if they have any partial disability. Usually for first-time VA home loan users, there's a funding fee that's 2.3% of the total loan amount that gets included into their total financing for the mortgage. Next product is USDA. I kind of talked a little bit about the changes around eligibility, but USDA stands for the United States Department of Agriculture. Those are for clients that need to purchase in maybe rural areas. It does offer 100% financing, minimum credit score of 620. Very similar to FHA, the loan amounts will vary based upon where in the country the client wants to purchase. There's two kind of major requirements for USDA. It's going to have to qualify as a rural area. And then we also have to look at the income based upon the household size for the clients. All right. So that's a little bit of a look at what products look like for our first-time buyers. Now, I get a lot of questions around private mortgage insurance or PMI. And so in our classes, we like to kind of do a little bit of a dive closer into PMI to explain a little bit more about what it looks like as we look at both the conventional and the FHA home loan products. Now, PMI stands for private mortgage insurance, and then MIP stands for the mortgage insurance premium. Ultimately, these mortgage insurance products provide insurance to the lender against any default by the buyer. So it gives the lender protection, but the buyer is responsible for the payment of that. Now, on a conventional loan, PMI is going to be based upon down payment, credit score, and then what I decide to finance. Okay, so the higher my credit score is, the higher my down payment is, the lesser cost I'm going to incur with PMI. Now, PMI on a conventional loan does have a cancellation option. So once I reach 2 years in my loan and I achieve 22% equity, I can apply to have the mortgage insurance canceled. So if we looked at a scenario of, let's say, financing $300,000 and I was putting a 3% down payment and I have a 740 credit score, my PMI is probably about $92 a month. Okay, so maybe not as expensive as you might think, especially if you've started some of your home search on Zillow or Redfin, because what I found in my kind of like research is that you generally will see the PMI calculations be a lot higher on those sites because it doesn't factor in those three criteria. Now, on the FHA side of things, FHA is a government insured loan, so it does have two components to mortgage insurance. One is there's monthly MIP, which is 0.55% of my loan amount. Then we also have to add in upfront mortgage insurance, which is 1.75% of my loan amount. That gets now financed into your mortgage balance, so it doesn't affect your cash out of pocket, but certainly increases the total amount borrowed when we use an FHA loan. Now, FHA loan's a little bit different than a conventional loan because there is no cancellation option on the mortgage insurance. So even though I reach, let's say, 20% equity in my home, I have to refinance out of the FHA loan into maybe a conventional product in order to get rid of my mortgage insurance. So when we look at the calculations for FHA as opposed to conventional loans, upfront mortgage insurance for an FHA loan is about $5,200 a month, and then the monthly premium is $137 per month. So FHA is going to be a lot more of kind of an expensive option for our clients, but it does give entry to homeownership for someone that may not qualify in a conventional product, maybe because of credit scores, maybe because of my income situation or my expenses to income. There's a whole variety of different reasons, but ultimately this kind of helps you better understand like what's the differences look like between PMI for both the conventional and the FHA product. So as a takeaway, when we design financing options for our clients, we're going to figure out which product makes the most sense for you based upon your credit score, versus basis, what type of down payment you're looking at. All those things are going to be really important elements into designing a home buying plan for you. Now, another thing we're going to take a look at is income. And so in our classes, we always like to kind of dive a little bit deeper in explaining qualifying income. In fact, I just had a conversation with a client that kind of was one of those misconceptions that we hear from clients, which is thinking that I have to have like 5 years on my job in order to qualify for financing, which just isn't the case. We have to verify a 2-year work history or educational history for financing. So you don't have to necessarily be on your job for a set amount of time. We just have to verify a track record of earnings. So ultimately, when we determine financing, we're going to verify, education or income history. through a variety of different documents that we request. That could be last 2 years of taxes, a couple years of W-2s, 60 days to 30 days of pay stubs, things of that nature. So when we look at work history, we have to verify 2 years of education or work history. So if you just graduated from Mississippi State in the fall and you just started your job January 1st, well, let's face it, you don't have 2 years on your job, but we can verify that full 2 years between your academic history and your employment history and be able to meet the qualifications for financing. So, it is kind of a bit of a misconception in the marketplace that I have to have a certain amount of years on my job. We even have situations where clients are, transitioning to a new job. So let's say I've been in my current job for 5 years, but I got this really awesome opportunity to start with another company. As long as I can show that I have an offer letter for my new company, I can potentially use that for qualifying purposes. Now, where 2 years gets a little trickier is for self-employed clients. So if I have a business that I've filed 2 years taxes on, that would make me eligible to use my self-employment income for qualifying. But if I only have my business for a year, unfortunately, that wouldn't work from a qualifying perspective. Now, if I have a 40-hour work week job, but I also drive for, let's say, Lyft on the weekends, and I want to introduce that Lyft income into the qualifying picture, then in that case, I do have to show 2 years history for both sources of income. Also, that plays a role for clients that have multiple jobs. So sometimes we see this in the healthcare industry where someone works 30 hours for one clinic, then maybe 20 hours for another clinic. In order to use both sources of income from both of my jobs, I do have to show that I've been able to demonstrate working both jobs simultaneously for the last 2 years. Last thing I want to touch on before we move out of income and talk a little bit about income versus expenses is additional sources of income like rental income, or if I have a partner that's involved in helping out my household. I can't introduce those income sources, especially on the rental income side of things, because it won't probably carry over to the next property. And for partners that are supporting, the household with their income, unless they're going to be part of the application, we can't use the income from a qualifying perspective. All right. Now, in looking at income, we also compare income versus expenses. We call that calculation debt to income ratio. Really super easy calculation, but I like to walk our classes through it so you can kind of understand a little better. It takes into consideration the existing payments that you have today on personal loans, credit cards, student loan payments, whatever that might look like, as well as what the new housing payment's going to be, principal and interest of the loan, property taxes, homeowners insurance, maybe mortgage insurance. We take those numbers and then we divide it by the gross monthly income, and it gives us a percentage. So ultimately, we want to see what the expenses consume of your income on a monthly basis. Now, ideally, we don't want those expenses to be more than 45 to, well, let me back up for a second. That ideally 36% is generally an ideal range, but the maximum qualifying is 45 to 50%. So a lot of clients will kind of ask me, Jason, where should we target our number for debt to income ratio? And I think for most clients that I partner with in homeownership, it's right around 33 to 36% is generally the number that I see is probably the right fit. But from a qualifying perspective, you can go as high as 45 to 50%. I provided you with a quick little example here. You can see the principal and interest and taxes and insurance, PMI for if we put less than 20%. We also made an assumption if we put an HOA, if we're buying a condo or a townhouse. So this particular client has $2,500 in housing expenses, $500 in other debts, and they're making $8,500 a month. So if we take that $3,000 expenses divided by the $8,500 in income, we have 35.3% in debt to income ratio. So this would be a client that's really buying in that smart range for them, 33 to 36%. Now, ultimately, this is just a guideline for us in qualifying. Doesn't necessarily measure affordability, which is a much more important number for us. We're going to have discussions around affordability as part of your consultation, because as we think more about home ownership, we want to make sure that we're going to create a plan for you that's affordable and sustainable over time. All right, last thing we want to talk about when it comes to building our plans for home ownership is savings for home ownership. And quite honestly, that's probably one of the bigger challenges for most of our clients in preparing for home ownership. because, maybe we're just new in our careers and we're trying to kind of figure out and get our financial footing. But ultimately, savings can be a challenge. Also, credit can be as well. But let's talk a little bit more about savings. And so here's some of the documents that we generally need to prepare for when it comes to savings. So generally, we want to view the last 60 days of bank activity, because we do have to make sure there's no cash deposits in those bank accounts. Any large deposits that we see there have to be all sourced. And then we have things like retirement accounts that can potentially be used, brokerage accounts. We always encourage clients, talk to your financial or tax advisor before you access those assets. We don't want to create any tax issues for yourself. Gift funds can also be used for you in home ownership. That's where a family member is helping contribute to your home purchase. Now, with gift funds, they don't need to be seasoned like other funds. So traditionally, a buyer needs to have their assets seasoned 60 days in their account, but gift funds can be used right away. So those are a little bit different, and there's a documentation process for those gift funds. Now, as we prepare for home ownership, I wanted to provide our class with a really simple savings plan to help maybe kind of frame up this kind of charting this course towards home ownership. And it looks a little bit like this. So let's say I'm paying $1,500 a month in rent today, but after meeting for your consultation, you feel like, hey, I think I can elevate my outgoing expenses to about $3,000 per month, but I just don't really have a lot of savings resources. So what would I would encourage that client to do is to start paying into my savings account like I'm making a mortgage payment today. So on the 1st of July, I make my $1,500 payment to my landlord, but I create that discipline of paying actually $3,000 a month, because $1,500 goes to my landlord. The other $1,500 goes to my savings account. And before you know it, if I can create that discipline, by the end of 6 months, I have $9,000 that is now grown into my savings account. End of 12 months, I have $18,000 that is in my savings account. And those are real game changers for many clients, because that amount of money can certainly help a client access homeownership. And this is certainly a plan, but I think ultimately that can help propel us closer to homeownership by creating a savings plan like that. Now, not all of us are in a position to save at that level. And as we're thinking about homeownership and preparing for that, there are first-time buyer programs available all across the country. For tonight's class, we're obviously spotlighting the Mississippi market, but for those of you that might be joining us in other parts of the country, generally each state has a first-time buyer agency. They're usually called housing finance agencies, and they're there to support low to moderate income households. Low to moderate would mean someone earning 80% of the median income, to moderate could be 100% of the median income. At some cases, in certain states, it'll be 150% of the median income. Now, in Mississippi, there's the MHC loan program, which provides $6,000 to $10,000 in down payment assistance, which is essentially a zero interest rate loan. There's also special programs for teachers, and then there's a mortgage credit certificate. What a mortgage credit certificate does is it essentially provides you with a tax credit as a percentage of the amount of interest you pay on an annualized basis. Usually that tax credit is up to 10 to 15% of the interest you pay on an annual basis. As long as you retain the home as your primary residence, MCCs or mortgage credit certificates will last the entire life of the loan. And then there's, for certain areas that are targeted, there are some additional special programs available. So if it's a underserved community or a low economic market, there are special programs available for first-time buyers in some of those areas. And I also want to share with you the Pathway DPA program. That program is available just for FHA, but it does provide up to 3.5% to 5% of your loan amount in assistance funds that can be used to help ultimately reduce down your total out-of-pocket expense. All right. So, as we think about homeownership, there's a lot of great resources for you out there. And obviously, when we teach classes like this, we want to make sure that you can participate in some of those programs to help make homeownership so much more of a near-term goal for you. Now, as we look at the process of home buying, this is going to be our last topics for tonight's discussion. I want to take you through the 6 steps of home buying. Now, after we leave this session today, we love to be able to get connected with you for a free consultation. That free consultation allows us to help design some home buying options for you. Now, whether you want to buy in 2025 or 3 years from now, I think a consultation is a really effective way of helping kind of chart your course towards home ownership. Now, as we leave that consultation, whenever that time comes, that will initiate what we call as a pre-approval. Now, pre-approval allows you to start actively shopping for homes and making offers on homes. Now, whether that happens right away or maybe we have to wait a little bit, ultimately, step one is the pre-approval. And that pre-approval is good for 60 days, but it can always be recertified for you at any time. As a reminder, when we access your credit file in designing home buying plans for you, it's only a soft credit check, so you don't have to worry about your score being impacted. And the application that you use to submit for your pre-approval lasts for 2 years. So you don't need to feel a pressure of running out and buying a house right now. We just want to make sure you understand what all your resources look like for you and ultimately kind of provide a game plan towards home ownership. Now, the next step is the home search. And whenever that happens for you, it can start online, obviously, and then kind of probably transition to in person. We always recommend getting connected with a local realtor in your market because they should be experts on what's happening in the housing market, experts in negotiations, be partnered with various inspection companies, have a good base of colleagues that they can draw from, but ultimately provide a good resource for you in your home search. Now, if you find a home that you love and you want to submit an offer on that home, let's say that offer gets accepted. Well, then if that acceptance happens, you're going to move to step 3 in the process. That's called entering escrow. So you and the seller have agreed to terms in the contract. That also starts to kind of kickstart the process of the financing to the next step. And on that same day that we hear about your acceptance, you're going to get a call from me saying, congratulations, you did it. You got an accepted offer, which honestly is part of most of the heavy lifting in buying a house these days is just to get an accepted offer. But within a few days after that accepted offer, we're going to meet up for what we call a follow-up video session to go through all the redesign work of your financing. We're going to take a look at what we put together for your pre-approval. And now that you have a ratified contract with the seller, talk a little bit about really what the main ingredients look like for in your financing. What's the monthly payment look like? What are today's interest rates trending at? What's your out-of-pocket expense? All those really important things. You'll now start to also receive disclosures in the process that kind of highlight some of the numbers that we've reviewed in your follow-up consultation. And then we'll start working on different activities behind the scenes for you, which includes ordering an appraisal of your property to ensure the home is worth what you're buying it for, also getting your loan approved. And we'll talk more about that. Now, in most contracts across the country, you do have to participate with what we call an earnest money deposit, which is usually 1% to 2% of your purchase price. Now, that amount of money will count towards your total out-of-pocket expense in home ownership. And most contracts in the United States have what we call a contingency period attached to them, which allow you as a buyer to do some research on the property before you go to the final closing stages, which includes getting your house appraised, getting your house inspected by a licensed inspector. And there's a variety of different inspections you can do. You can do roof inspections, sewage, whatever the case may be. And then of course, getting your loan approved, in which we'll take care of that as your partner in the home buying journey. Now that kind of moves us along in the process with those contingencies. That takes us now to step 4, which is the processing and the underwriting of your loan. That's a lot of the administrative tasks that we do, things like verifying your employment, your assets. We're going to be obviously watching what interest rates are doing to make sure we can lock in the lowest available interest rate for you. So all those things are kind of happening during this process. Step 5 is going to be the loan approval phase. And that's where we're kind of get to about 3/4 of the way through the process. At that time, an underwriter has now approved your loan. We are now probably at the end of the contingency period of your home purchase. And now things are going to start to finalize. And we also, in the finality of this, issue to you a final closing disclosure, which essentially provides you a 3-day cooling off period before we go to the very end of the process, which is called the closing of the loan. Now, that is one of the in-person activities that you have to do as a buyer. You'll be signing final loan documents on that day and then contributing your final funds that are due for the transaction. That process usually takes about an hour or so. Those documents get uploaded back to us as the lender, and then we wire in the funds for your first mortgage and any type of assistance funds that you're going to get access to. Those funds then get reconciled, and then documents get recorded with the local county recorder's office. They usually record a grant deed that transfers ownership to you, as well as the deed for the loan. And after we have confirmation that that all occurs with the recording, then we get a chance to celebrate with you and say, hey, congratulations. Now you're a new homeowner. I get a chance to make those calls every day. It's best part of my day, bar none, because it's a huge accomplishment. I mean, our relationship usually starts in the classwork right here, and then we kind of move into pre-approval, home search, and then eventually you get the keys to your house. So it's certainly a day of celebration. Our relationship doesn't stop there, though, because part of the aftercare that we do with our clients includes Like, let's watch what interest rates are doing. So if it ever makes sense to refinance, we want to be a partner for you in that. We put you in our HomeBot system to kind of track your home equity position and making sure your investment is growing for you, and checking in with you on an annual basis to see what's going on with you financially. Is there anything that we can help you with to make sure you're in the best possible position? Well, we're wrapping up tonight's class, but before we do, I just want to let you know kind of how you can get started in the process. So if you want to get connected with us for your free home consultation, you can do so by completing an online application. You can see the link there. You would then upload documents that you have, like proof of income and assets, and then you use our scheduling system that you can see on screen to schedule your one-on-one session with me. That's a free session. We do that with a 30-minute session time. And then we just kind of design a game plan for you around homeownership. Whether you want to buy today or a couple of years from now, we just want to make sure that you have all the right resources in place. Now, I know we didn't get a lot of questions tonight, but if you do have some questions after tonight's class, you can sign up for an introductory call, and I will be more than happy to hop on a call with you just to answer maybe some personal questions you have around home ownership. And this is what our consultation looks like. So we're going to talk a little bit about affordability. Where do I want to buy? Maybe some first-time buyer programs that pique my interest, and walk you through the buying process. And if you're ready to go and you want to be pre-approved, we'll take care of that during that free consultation service. Last thing I want to point out is resources for you. We obviously embrace technology in the process with our clients. We create a high touch experience, but we can also leverage technology like mobile to start the process. You can use the calculator function in there and also get push notifications as you move through the home buying process. So that mobile tool is a great way to start the process for yourselves. And last thing I wanted to spotlight is our discount again that we have with the Mississippi State Alumni Association. We're super proud of our second year of partnership with Mississippi State. It's been a really fruitful relationship, and we love helping our community in homeownership. With that, we do pass along that $750 discount in your closing costs. Obviously, we have 4 classes available to you throughout the year to help kind of tune up homeownership for you. If you do have any friends or family or coworkers that would, benefit from these classes, they're always welcome to join one of these classes. We also have other partnerships across the country that you can see here. And if they want to join one of those classes, they're more than happy to, we're more than welcome to do that. Okay. Here's my contact information. If you have any questions, I know we got a question in the chat, which I'm going to answer in just a second. Here's all my contact information. You want to reach out to me, feel free to send me a message or call me, whatever works great for you. We do have all our social channels up here. As a reminder, this class will be up on our YouTube channel tomorrow. So if you want to kind of look back at your notes and maybe share some of this content with friends or family or coworkers, feel free to do so. We'll also provide all of the presentation material tomorrow morning. All right. I do appreciate you spending your time with us this evening. Before I wrap up, I just want to touch on a couple of questions I got in the chat, or one question I got in the chat, which is, do you work with residents of other states that are not looking to buy in Mississippi? And the answer is yes. Yeah. So we are a nationwide lender, and I personally am licensed in multiple states across the country. So yeah, we can absolutely help you whatever market that you're in. And obviously one of the great things with technology is we meet with all of our clients over video. So whether you're in Kansas or California or Texas or Mississippi, we can help you in whatever community you want to pursue homeownership in. Thank you for that question. I appreciate that. Any other questions from our audience? I appreciate everybody hanging tight. I know it's difficult for these classes because I'm right in front of dinner time, but I do appreciate you all hanging on. If you do have any questions that come up and want to just talk offline, again, you saw my contact information, please feel free to reach out. I do hope I get a chance to help meet with you to help design your own home buying plan to help you pursue homeownership. We're really passionate about serving our communities in affordable homeownership. And so we look forward to connecting with you in the future. I wish everyone a wonderful night. Enjoy the rest of your week, and I'll see you soon. Good night.